Ladies and gentlemen, thank you for joining me today. I want to start with a principle that has guided much of my thinking. History and logic matter more than emotion. Right now, we are living through one of the most consequential stories of our time, a debt-fueled monetary system that is being stretched to its limits. When you look at that reality objectively, you begin to recognize that owning real debt-backed assets is not just prudent, it may be essential. We are now confronting one of the great systemic risks in the global economy, a debt cycle that has expanded far beyond sustainable limits and that threatens not only financial markets, but the very foundations of our monetary system. When you examine it dispassionately, history and mechanics make a compelling case. We are in the late stages of a long-term debt cycle, and the risk is no longer theoretical. It is real. At its core, this risk arises because debt has grown far faster than the capacity of economies to service it. Credit expansion has fueled growth, driven asset prices higher, and created a sense among many participants that we are riding an endless wave of prosperity. That wave is built on borrowed time. Literally, the income generated by productive economic activity has not kept up with the burden of accumulating obligations. Interest payments, the cost of servicing debt are rising, and they are beginning to crowd out everything else. Public spending, investment, social programs, it's like having too much plaque in an artery. Eventually, the flow gets obstructed as the burden of debt service mounts. Governments face a mounted dilemma. They must either tighten cutting spending, raising taxes, pursuing austerity, or find another way to make these obligations more manageable. Historically, one of the most common solutions has been to print money. This is not a conspiracy theory. It's the easiest lever available when a country owes more than it can comfortably pay. Rather than defaulting outright, which would be politically and economically devastating, central banks often step and monetize the debt and thereby devalue the currency. That devaluation is not without cost. It erodes the real value of money, penalizes creditors, and disproportionately hurts those holding fixed income promises. This mechanism, borrowing and monetizing, is not new. It is the recurrent heart of the long-term debt cycle. There are phases. An early sound money phase in which debt is relatively low and assets are valued conservatively. Then a credit-fueled boom in which borrowing feels easy and returns look generous. Finally, a tipping point when the burden becomes too heavy, when interest costs escalate, and when confidence in the system falters. In that phase, financial stress builds, debtors struggle, and central banks intervene. Sometimes there is restructuring, sometimes there is default. More often there is money printing, and that leads to devaluation and inflationary pressures. Makes the current situation particularly precarious is that we are not just talking about a single country's debt. We're talking about a global system where the major reserve currencies themselves are under pressure. Debt denominated in those currencies, especially in US dollars, has ballooned. At the same time, real yields are low, borrowing is cheap, and central banks are holding enormous balance sheets. These dynamics create a dangerous tension. If foreign investors lose confidence in sovereign debt, the demand could collapse just when supply is surging to roll over maturing obligations. When demand falls while supply is high, interest rates must rise to attract buyers. But higher rates increase debt servicing costs, feeding the very problem that triggered the risk in the first place. In that moment, policymakers face a stark choice. Let interest rates climb, risking defaults and painful restructuring, or intervene by printing money, monetizing the debt, and accepting currency devaluation. History teaches us that they often choose the latter. Why? Because default is messy and politically dangerous. Printing money, while inflationary, is seen as the simpler path. But that decision produces side effects. Inflation erodes savers' purchasing power, undermines trust in the currency, and in extreme cases can lead to a flight into hard money, tangible real value assets. Yet even printing money is not a panacea. When currency devaluation accelerates, people start to lose faith in the system. They look for alternatives that they may turn to real assets, to commodities, to hard currencies, or to other stores of value. That flight erodes the value of dead assets because those promises are now denominated in units losing purchasing power. Meanwhile, the underlying debt burden remains, but its real cost has been masked by inflation. Over time, the balancing act becomes increasingly unstable. Compounding this is the political dimension. Debt crises are not purely economic, they are deeply political. As debt burdens rise, living standards may stagnate or decline, frustration grows, populist pressures intensify, leaders face difficult choices. Cut spending is unpopular, raise taxes divisive, or continue monetizing as inflationary. Redistribution becomes a tempting lever. But so does currency weakening. In many historical episodes, governments have resorted to multiple levers. A mix of austerity restructuring, redistribution, and money printing. One hopeful path is what some call beautiful, the leveraging a combination of monetary stimulus, fiscal prudence, controlled inflation, and reforms that restore growth. The goal is to reduce debt burdens without triggering a destructive default or hyperinflation. Achieving that balance is very hard. It requires coordination, discipline, and above all, credible policy. Something that is in increasingly short supply amid geopolitical fragmentation, rising inequality, and shifting power dynamics. If policymakers fail, the consequence could be a debt-death spiral, rising interest rates, debt servicing costs that consume revenues, resorting to printing money and devaluation. That is a self-reinforcing loop, and it is exactly what many historical crises reflect from an investor's perspective. This macro risk demands attention. It's not just about default risk, it's about currency risk, inflation risk, and systemic resilience. Holding pure debt or cash may no longer provide the protection many assume. When money is cheap, debt may be cheap. The long-term cost could be far greater than appears now. Understanding this cycle, how it arises, how it peaks, and how it unwinds is critical. If you misjudge where we are in the cycle, you misjudge risk. That's why, as of now, one must think not only in terms of what traditional portfolios offer, in terms of real non-debt assets, diversification, and protection against currency devaluation. This is a moment of structural fragility. The enormous debt overhang is not just a financial problem. It is a macroeconomic and monetary risk that could reshape the playing field completely. If we are entering a new phase of deleveraging, or worse, a debt spiral, will require thoughtful navigation and an understanding that money, debt, and credit are intimately interwoven. History does not repeat itself in exactly the same way, but its patterns rhyme, and we ignore those patterns at our peril. When you think carefully about silver, strikes you as its hybrid identity. It is not merely a relic of monetary history, nor simply another industrial commodity. It occupies a rare and powerful juncture, a bridge between money and utility, between store of value and productive real-world use. That dual nature is precisely what gives silver a special place in a world that increasingly fragile, dynamic, and in flux. On one hand, silver has long served as a monetary metal across centuries and civilizations. It was used as money. It carried value independent of credit or debt simply because it real, tangible, and universally accepted. Even today, that legacy matters. In times of monetary stress or currency debasement, silver can act as a non-fiat anchor, way to preserve purchasing power outside the promises of paper or digital money. Because it is a physical asset, it resists the dilution that comes with money printing or unchecked credit expansion. When confidence in currency falters, silver's monetary characteristics give it a role, not just as a speculative asset, but as a genuine hedge. Yet silver's story doesn't end there. Unlike gold, which largely remains locked away in vaults, silver is a working metal. Its industrial applications are not peripheral. They are central and rapidly growing. The metal's electrical and thermal conductivity is unmatched, which makes it indispensable for a vast array of modern technologies. In photovoltaic panels, the backbone of the solar energy revolution, silver paste forms the conductive pathways that allow electrons to be collected and transported efficiently. Without silver in those solar cells, conversion efficiency would suffer. Silver is not a luxury in this context. It's a functional necessity. Beyond solar, silver is woven into almost every advanced piece of electronic equipment and semiconductors, printed circuit boards, flexible electronics, touchscreens, and even in the proliferating Internet of Things, silver is the invisible workhorse. Its ability to conduct with minimal resistance means less energy loss, more reliability, and better performance because technology is advancing at a rapid pace. 5G data centers, electric vehicles, demand for silver is not just rising, it is structural. Silver also finds use in brazing alloys and soldering, where its integrity under high heat and its resistance to corrosion make it a preferred material to join metals reliably. And in the medical space, silver's antimicrobial properties give it relevance in wound dressings, medical devices, and certain types of surfaces. Because these industrial uses actually consume silver, locking it into products like solar panels, circuits, and medical devices, that portion of supply is not easily recycled or returned to commodity markets. Once silver is integrated into a cell or a circuit for all practical purposes, it stays there for a long time. That dynamic physical consumption is crucial. It means that industrial demand does not just sit in inventory. It removes silver from the system. This transforms silver supply-demand balance. When more silver is consistently used up in industrial processes, it effectively tightens the available pool of metal, even if new mine production is growing too. And this tightening matters profoundly for investors and for the macro picture. Permanently higher base demand makes silver's value less dependent solely on investor sentiment or monetary speculation. At the same time, its monetary quality means silver can respond to macro risks. In an environment of monetary instability, or when central banks resort to aggressive balance sheet expansion, silver offers more than just industrial utility. It offers a store of value. Unlike industrial commodities whose prices collapse when demand slows, silver has a fallback demand base grounded in its monetary appeal that gives it resilience. And because of its dual role, it is less likely to experience a pure industrial downturn. Even if the economy weakens, monetary demand can pick up the slack from a risk management perspective, holding silver as a hedge, not only against macromonetary dislocations, but also against underinvestment in the infrastructure of the future. If the world is transitioning to renewable energy and electrified transport, you need materials that are not just abundant, but functionally irreplaceable. Silver fits that description. The inevitability of solar expansion, of electronics proliferation, and of electrification creates a continuous structural demand stream. That demand stream insulates silver not just as a speculative asset, as a strategic real asset. Moreover, because significant portions of silver supply are byproducts of mining for other metals such as copper, lead, or zincs, its production is not as responsive to price increases as one might expect. This means that surging industrial demand, combined with its monetary role, can lead to persistent deficits, especially since recycling is limited for many of the applications in which silver is used. Such a supply structure amplifies the dual value effect. Demand is structural and sticky. Supply growth is constrained, and monetary demand can rapidly pick up in times of financial stress. In essence, silver is a two-engine asset. One engine is monetary, the traditional intrinsic value that protects against currency debasement and systemic monetary risk. The other is industrial, the future-facing engine of technological growth, renewable energy, and infrastructure transition. When you combine those engines, you don't just get a commodity, you get a strategic asset that is both a hedge and a bet from a long-term perspective that makes silver uniquely compelling. It is not purely speculative because it has real functional demand. It is not purely a commodity because it retains monetary value. That duality means that as global trends evolve, whether through green energy expansion, continued technological innovation, or monetary disequilibria, silver has the potential to benefit from multiple macro tailwinds. If one were to construct a resilient futureware portfolio, it makes sense to allocate to silver, not merely for speculation, but as part of a risk management framework to preserve wealth, to hedge against currency risks, and to participate in the material transformation of our economy. Silver's dual role is not some accidental quirk. It is a fundamental characteristic that aligns it with both the past and the future. In short, silver is not a relic or a single-used metal. It is both heritage and utility. That combination, the blend of monetary standing and industrial indispensability, is why it is likely to remain relevant and valuable for decades to come. One of the most important principles in investing and in managing financial risk over the long term is the concept of diversification. Diversification is not merely a recommendation for the cautious. It is a fundamental mechanism for navigating uncertainty. In a world dominated by complex interconnected economies where debt levels, monetary policies, and geopolitical tensions shift rapidly, placing all your resources in one asset or one market is tantamount to ignoring reality. The markets are inherently unpredictable, and even the most sophisticated forecasts are vulnerable to unforeseen events. Therefore, protecting yourself against multiple outcomes is not optional. It is essential diversification works because different assets respond differently to the same forces. Equities, bonds, commodities, real estate, and cash all have their own risk-return profiles, their own correlations, and their own reactions to macroeconomic shocks. When one asset underperforms due to a particular event, for example, rising interest rates or credit crisis, another may outperform because its drivers are different. By holding a mix, the total portfolio becomes less sensitive to any single risk factor. The goal is not necessarily to maximize short-term returns, but to manage the risk of catastrophic loss while capturing long-term growth opportunities. A critical insight often overlooked is that diversification is not just about spreading investments across assets. It is also about recognizing asymmetric opportunities. In finance, asymmetry refers to situations where the potential upside significantly outweighs the potential downside, or a risk is clearly defined and manageable relative to potential reward. Asymmetric opportunities are rare, but when identified and utilized correctly, they can have a disproportionate impact on overall wealth accumulation. Take, for instance, investments in non-traditional assets that behave differently from standard equities and bonds. Assets such as precious metals, certain commodities, or specialized real assets can serve as both hedges and sources of growth. Their performance is often driven by forces outside the conventional financial system: supply constraints, technological adoption, industrial demand, or monetary pressures. Because these drivers are distinct from those affecting the broader market, allocating a measured portion of capital to such assets can provide protection against macroeconomic shocks while preserving the possibility of significant gains. The concept of asymmetric opportunity is closely tied to understanding risk in absolute terms. Many investors evaluate opportunities based on their potential returns alone without properly weighing the consequences of adverse outcomes. True symmetry emerges when the downside is limited, controlled, or clearly understood, while the upside remains substantial and often unbounded. Structuring a portfolio with this principle in mind requires disciplined research and patience. It is not about gambling on unpredictable events, about recognizing situations where probability, leverage, and systemic conditions align to favor one outcome more than the other. Diversification amplifies the effectiveness of asymmetric opportunities. By spreading capital across uncorrelated assets, you reduce exposure to any single source of risk, which in turn allows you to take calculated positions in higher potential asymmetric opportunities without jeopardizing overall stability. This is particularly important during periods of macroeconomic uncertainty. When debt levels are high, monetary policy is aggressive, geopolitical tensions flare, correlations between traditional assets can rise unexpectedly, and previously safe assumptions about risk may fail. A diversified portfolio with asymmetric exposures functions as a buffer. It mitigates losses and stress conditions while retaining optionality to benefit from unexpected positive developments. An often underappreciated aspect of diversification is its psychological benefit. Market volatility is stressful, and investors frequently make poor decisions under pressure. By holding a diversified set of assets, you can maintain confidence and composure because the portfolio is designed to withstand shocks. Emotional discipline is as important as analytical rigor. A portfolio that manages risk intelligently allows the investor to remain focused on long-term objectives rather than reacting impulsively to short-term noise. To achieve effective diversification and asymmetric opportunity, one must also consider timing, liquidity, and horizon. Not all assets are equally liquid, and not all opportunities manifest in a way that allows immediate capitalization. A well-structured approach takes into account the time it may take for certain positions to yield results, the liquidity needs of the investor, and the potential for systemic shocks to disrupt normal market behavior. Balancing these factors enhances the robustness of the portfolio and ensures that asymmetric opportunities can be seized without introducing unmanageable risk. Moreover, diversification does not imply a rigid allocation to predefined categories. It is a dynamic process requiring continual assessment of correlations, valuations, and macro trends. As global debt levels rise, as inflationary pressures evolve, and as technology reshapes industries, the relative performance of assets will shift. What was once a safe hedge may become less effective, while an overlooked asset class may emerge as an asymmetric opportunity. Active evaluation combined with disciplined adherence to principles of risk management allows one to maintain a portfolio that is resilient and opportunistic. In practice, a portfolio that incorporates diversification and asymmetric opportunity is not about achieving the highest possible return in a single year. It is about survival, stability, and the ability to thrive across cycles of boom and bust. It recognizes that markets are interconnected, that risk is multifaceted, and that wealth is best preserved and grown by anticipating the unexpected, by combining assets with low correlations. Hedges against macroeconomic shifts and positions that offer asymmetric upside. An investor positions themselves to benefit from both growth and protection simultaneously. Ultimately, the lesson is simple yet profound. The future is uncertain and the world is complex. By embracing diversification and seeking asymmetric opportunities is not trying to predict the unpredictable with perfect accuracy. Instead, one is designing a system, a portfolio that can endure volatility, exploit favorable conditions, and withstand shocks that would devastate less prepared strategies. This approach, grounded in history, principles, and rational analysis, is not merely a tactic. It is a fundamental framework for navigating the financial world with foresight and resilience. Ultimately, investing is not about speculation, it's about preparation. To own 1 kilo of silver today is not a speculative bet. It's a principled stance rooted in understanding how the world works, debt cycles, money creation, industrial dynamics, and investor psychology. If history teaches us anything, it's that imbalance is correct, often with force. So I encourage you to think seriously about real non-debt assets. Think about owning a kilo of silver, not because it's trendy, but because it could be one of the most effective ways to preserve wealth in a world where money, as we know, it may be losing its power. Thank you.